I would like to talk about how factor investing works. When we talk about factor investing, it's a strategy that where the investor invests with the aim of taking advantage of a specific factor that drives returns. Over time, specific factor that drives returns that enhances, the portfolio performance, over a given period. So the approach involves selecting an investment based on a certain characteristics. These are known as factors that are believed to have the potential of driving returns and performance, over time. So I want to consider the key concepts, of factor investing. Number one, I want to highlight. I want to talk about the definition as well as the purpose. When we talk about factor investing, as told us earlier, it's a strategy that involves, targeting a specific factor or characteristics such as value, such as size of the company, such as the momentum, such as the quality of the company, and other factors that are believed to have the potentials of enhancing the returns on your investments, or that could influence returns, over time. And the objective here is to achieve, a better risk-adjusted returns by focusing on factors that historically, are known to contribute to a higher investment return. A typical example is, could be value, it might be growth, and it's equally, contribute, not only in excess returns to enhance returns. This kind of investing equally, helps to reduce risk. Number two is common factors we want to talk about. Number one is value. A typical, very popular factor is value. So investing, in undervalued stocks, are known to provide, higher returns over time. Stocks with, low PE ratios, low price to book ratios. The idea is that undervalued stocks or ignore stocks, tends to outperform, over time as their prices, as the value, as investors get to realize the value involved, the market correct, the stock will kind of correct itself, and then before you understand, it will embark on an upward trajectory. A company will not remain, undervalued for too long a period of time. Eventually, it will get to appreciate. Another factor is size. In investing in smaller companies, that are small cap stocks, historically have delivered higher returns compared to higher or mega cap stocks. This is based on the size effect, where smaller companies tend to outperform bigger companies. That's a fact. So another factor is momentum. So investing in stocks that show strong recent performance, with the expectation that the performance would extend into the future. So momentum investors invest in stocks that are performing very well. And all things being equal, outperforming stocks will tend to outperform, and undervalued stocks might tend to remain undervalued sometimes, most of the times, over a short period of time. And so this is based on what is called the momentum effect, where trends persist. Trends, tend to persist for lengthy periods. Another factor is quality. Investing in companies with high qualities, strong balance sheets, strong financials, strong profitability, and low debts, high cash turnover. So quality factors often lead to more stable returns. You equally have low volatility, investing in stocks with lower, price volatility, which aim to reduce risk and provides, more stable returns over time. Number three is how does it work? How does this particular investment strategy work? So generally, there's this number one, factor identification. In this case, you identify a factor, a given characteristics of a stock you believe is going to drive returns over time. Identify the factor, through historical data and through research. Number two is that you perform, you kind of, construct your portfolio construction. So build a portfolio that emphasizes stock or assets with that, factor in mind. This can involve using factor-based, uh, factor-based indices, factor-based, ETFs, factor-based mutual funds. It makes your journey, quite easy. And then you don't only just invest and go to sleep, you monitor your investments by regularly, and whenever the need arises, you rebalance your portfolio to mitigate risk and to help you obtain or attain, your investment goal at the end of the day. I want to also consider the benefits of factor investing, the pitfall, rather the advantages of factor investing is that enhance returns. It enhances returns by focusing on factors with a historical track record of enhancing, better returns. At the end of the day, your portfolio is going to yield the kind of returns you expect to get compared to traditional investing. You equally have risk management. So factor investing can help manage and diversify risk by targeting factors that can reduce the overall risk of your portfolio. So you incorporate a kind of risk reducing factors like value investing, is known for that reduction in risk level. You equally have customization. You allow investors to tailor their portfolio based on specific factors that align with their investment interests, and risk tolerance. Pick a factor that aligns with your personal interest, personal investment interest, and your risk tolerance. If you cannot tolerate, a higher level of risk, you can't incorporate value investing. The risk there is low, or you can equally go for, income generating kind of investing, like fixed income investing. That's a factor that is worth considering. Number five is the drawbacks and the disadvantages of the pitfalls of this strategy. Is that factor cyclicality, usually, there's that cyclical nature of the factor you want to get involved in. The factors can go out of favor over time. Sometimes, if you go for value as a factor, we all know that value investing is like going out of fashion. So that cyclicality in the factor you may tend to anchor your investment on, and it may underperform because of the cyclicality inherent in that particular. Just like value investing is underperforming now, that's a typical disadvantage. And not only that, there's that complexity. That complexity is equally, an inherent disadvantage of factor investing. When it comes to factor investing, it requires a good understanding of the factors and how they interact, which can be complicated for a typical individual investor. Except you're a professional, you may not know how these factors interact with one another. It involves professional knowledge. You probably have data and research dependence. It dependent on The efficacy or effectiveness of factor investing depends on the quality of the data and the research you've carried out, and how you are able to implement these factors. How authentic, how genuine, how transparent is the data you are working with. The quality of the data and your research is very important. So in this case, this is a very important drawback of uh, factor investing. And so who is it for? It's meant for those, who are experienced investors, advanced investors. It's meant for those who are looking for diversification, and it's equally meant for long-term investors. Long-term investors. You have long-term horizon, and you want to diversify, and you are an experienced investor, then this particular strategy is a good fit for you.